Up next is Ash Fontana, venture hacker at AngelList and perhaps future venture capitalist. Send me an angel, everything you need to know about online syndicates and the future of AngelList. How many people in the room know what AngelList is, if you could raise your hand? How many of you have an account on AngelList, made an investment, at least one on AngelList, running a syndicate on AngelList? Yes, great. Okay, well, we'll hear a lot more about that coming up. Let's welcome Ash up to the stage, ladies and gentlemen.
Thank you. So we're making our way back to the first slide. But essentially, Scott has told you today why you should put a lot of your money, if not all of your money, in technology. I'm here to tell you how. He's giving you the strategy. I'll sort of talk through the tactics. And I'll talk through those tactics in a world in which investing has finally been brought online, albeit 20 years after everything else. And what I really hope to do today is answer the question that was asked at the very end of that discussion, which was, if you can't necessarily get into a fund, if you don't want to invest in public markets, how do you do it yourself? And I'm going to say, well, today you can do it yourself online in a way where you don't have to add staff to your family office. You don't have to massively increase the time you allocate to investing. So let's start by just reviewing the old way, the offline ways in which you can get access to technology companies. Well, you could invest in the public markets, call up your broker, place a trade, and see how it goes. Amazon, Google, whatever. The problem is this guy will have beat you to it. And we've covered this, Scott covered this pretty well, and Mark Sester covered this in these slides at the last conference. But all the money would have been made by then. There's very little multiple expansion left by the time a lot of these tech companies are going public. They're growing more quickly than ever by leveraging the infrastructure of companies like Amazon and Google, and public funds are crossing over into the private markets and funding them right the way through. So you don't want to invest in tech companies by the time they get to the public markets. Your second option is, find a manager, find a VC fund to do this for you. The problem is, as the Kauffman Foundation proved here, unless you get in the very, very top quartile or even decile of funds, you're probably going to lose your money. Now, it's a combination of a bunch of different things, but one of those things being fees. With the typical 2 and 20 fee structure of a lot of funds, it's very hard to make returns on top of that. And you're very likely to just see your fees sail off into the sunset. The third option is going direct, and that is go private, find these early stage companies, and find them yourself rather than through a manager. Now, to do this, you probably have to be investing in about 20 companies per year to build a decent portfolio. And you probably have to be writing checks between 25 and 50K per deal. Entrepreneurs don't really want to deal with investors investing less than that. So that's 500K to $1 million per year. That might be a bit too much to allocate to private tech companies, but even if it is a good amount for you, it just takes a lot of time. So if you consider all the time it takes to find deals, research deals, meet teams, negotiate deals, deal with lawyers, and then get them done, and then you consider that you should probably only be investing in about 1% of the companies you see, doing 20 deals per year. That's 2,000 coffees and conference calls and whatnot to add to your agenda. I suggest perhaps a more useful use of 2,000 coffees is to make this mosaic of Elvis. So the new way is online. There are access problems getting into private markets. There are cost structure and fee problems going through a manager. And there are time and efficiency problems with the old way. But there is a new way, and that's what I'm going to talk through today. How the new way of online investing is more efficient, lower cost, and fairly flexible in sort of your level of engagement. So let's talk about how online investing can be efficient. Now, throughout, I'll give you a few tips. There will be a few sort of insider tips for how to make the most of a lot of these online platforms. But let's start at the very beginning, finding a company. With 500,000 companies on AngelList alone, it can be very hard. But thankfully, AngelList and other platforms that I'll go through have both automated and manual ways to curate the opportunities for you and to surface opportunities for you. In terms of automated ways, when you log into AngelList and you can go to your settings and there's this little part called Deal Flow, you can find investors that you like, investors that you want to follow the activity of, or you can just find sectors that you like. And then we will automatically surface deals getting traction from those investors or in those sectors. Investors find automated ways of surfacing companies like this, for example, that email on the left, this daily deals email, so useful that they invest $1 million a month just through that email on the left. And also, all of the platforms, CircleUp, Funders Club, AngelList, have manual ways to curate these companies for you. They all have committees that select deals either on the way in or once the deals are on the platform, surface them up for you. I mean, even the selection of the platform you want to use is curation in and of itself. For example, CircleUp will only do consumer products deals. AgFunder will only do ag tech deals. So there are a lot of options out there depending on how specialized you want to get and how active you want to get in the selection of your companies. But the point is, finding these companies online is far more efficient than trying to seek them out at conferences or in certain incubators or whatever else. So once you found the company, how do you research it? And how does that differ online versus offline? Basically, all of these platforms have really, really detailed portfolios with all sorts of information about the company, product videos, where the founders went to school, and even down to the exact terms of the deal. On AngelList right now, there are 51,000 companies that have detailed fundraising terms, deal terms posted on their profile. Some of the platforms like WeFunder here even do their own proprietary research. They run interviews with the founders, record the videos, and ask really good questions. And all of the platforms as well have their own Q&A features where you can ask your questions from the comfort of your desk. The cool thing about some of the platforms, and I'll go through AngelList here, is that they're fully fledged social networks. So you can do a lot of digging. They're not just static profiles of deal information. For example, here I'm looking at the team of a company and I take an interest in one of the people on the team, looks sort of interesting, has some recent experience, and I can just keep digging. I can keep looking into where they've worked and what they've done. So here I'll look into, I don't know, where he went to school. Australia, forget it. So anyway, if I did find a company that I wanted to invest in online, it's way more efficient. I mean, I'm sure all of us, judging by the survey just done, have been through the pain once of doing deal docs and negotiating these terms with the companies and whatever else. When you're investing on one of these platforms, that's it. That's all you have to do. You can download the closing docs for your records and read through them. The signatures are on the left and setting up the wires on the right. That's all it takes. On AngelList now, and we just launched this last week, you can even pre-fund your account, like a Schwab brokerage account, so that it will automatically execute deals based on instructions you've set ahead of time, whether you're on holidays or wherever you are, so you never miss a deal. And then once you've done the deal, you can manage all of your docs and all of your investor updates online, all in the one place. This really enables, smaller family offices, individuals to manage quite large portfolios with no or very few extra staff, because everything is all in the one place for you and it's all delivered online. So I've talked through how it can be more efficient, or you can actually invest fairly efficiently and directly in these private companies online. Now I'll talk about sort of the real meat and potatoes of it, and that is that it's actually just lower cost most of the time. So the big one is management fees. And most of these platforms operate on a cost plus carry model, not a management fee plus carry model, meaning that they will charge out very basic fees such as the cost of doing the regulatory filing in Delaware for the SPV that they set up to bundle the investment vehicle together, some basic legal and accounting fees, but that's it. They don't charge management fees that they take in for their platform, the people running the platform's salaries. And then they'll charge a carry, so you only pay for performance. Contrast this, obviously, to the traditional 2 and 20 model, where you're having 2% of your total committed capital taken away every single year. The other good thing about a lot of these online platforms is that all of them are deal by deal. So traditionally, when you're investing in a fund or a fund of funds, you've got a 10-year lockup. If you don't like how it's going halfway through, it's very, very, very hard to pull out. And good luck getting back into that fund if you ever don't do a capital call or pull out. Whereas on these online platforms, everything is deal by deal. So if you don't like how it's going, you can cut your managers. Instead of having 2 managers that you've committed to 10 years ahead, you can have a rotating bench of managers. You can have more managers. You can have any combination of managers you want. Finally, it's easier to get in early and get in at lower prices online. think about it. The barrier to entry for an entrepreneur to raise online is so low. Most of them create an AngelList profile before they even leave their job to start their company. And so what you see is a huge volume of very, very early stage deals on these platforms. On AngelList alone, even by the most conservative estimates, 75% of the deals are seed and Series A. And that's of the total companies. Of the fundraising companies, it's much higher. So you can get in early. You can get in before institutional investors bid up the price, or the companies just break out and get a lot of traction. So now I'll go into a little bit of the how. And there's a couple of things about online platforms that enable new types of investing. And my favorite analogy is to the public markets, where you can either pick a stock and be a bit of a day trader, you can find a mutual fund manager, or you can buy the index. And so I'll run this analogy through the online platforms and how do you do it. So pick a stock. Right now on AngelList there's about 40 deals active and open for online investing, and there's probably another 40 or 50 on the other platforms as well. Whether you're in the US or you're in Europe or South America, there are platforms all around the world. And so find a deal you like, it's surfaced in your feed, you see it featured by a company, your friend sends it to you, do some research and invest. There's a couple of cool things about picking a stock with these online platforms. And basically, it's that a lot of the minimums are very, very low, down to 1K on a lot of the platforms, which means you can actually build that portfolio of sort of 20 to 50 investments, as these guys were suggesting before, with the same amount of money. And so you can have a much more diversified portfolio picking stocks or going direct online. Now, there are a couple of caveats. When you're investing online, you're often not going to get to meet the team in person. And so the first thing I would advise is invest in traction. It's totally fine to invest in early stage companies based on the quality of the team, but I would suggest it's not necessarily the right thing to do if you're just investing online as opposed to offline. So invest in traction. That's something you can uniquely see and analyze on the profiles of a lot of these companies. Secondly, make sure you're mitigating downstream fundraising risk. That is, invest alongside institutions that can continue to fund the company beyond your individual capacity to fund the company down the line if things aren't necessarily going well. Thirdly, ask questions. All of these platforms offer Q&A solutions on the side and on the company's profiles, so you can actually deal with the founder in a fairly efficient way. Fourthly, make sure that the company is going to give you updates. Now, not that you'll necessarily be able to do anything about it if things aren't going wrong, but if only for your own learning as you invest in companies and learn how they progress. Fifthly, make sure the valuation's in check. And there are a lot of resources online, like this site I've got there, that'll show you the valuations across the entire market. And then finally, think intelligently about reserves. On AngelList and a lot of the other platforms, you are given the right to invest pro rata in almost every single deal. And so you should probably keep $1.50 or $2 for every dollar that you invest to invest in the later rounds, to double down on your winners. So that's the picking a stock option on these online platforms. The second is to trust a manager. So AngelList has Syndicates, Funders Club has partnerships, Circle Up has circles. There's a way that you can invest behind someone who brings the deal to AngelList, does the diligence, has the relationships with the founders, and then brings their allocation to AngelList. I'll just review how this works a little bit. So Elad here has a syndicate. He's got 35 investors that have said, I'm going to back your next deal, and I'm going to put 5K into your next deal or whatever else. And he's got 210K sitting there. When he finds a deal he really likes, he brings it to AngelList and says, the founder's given me a 260K allocation. I'm going to put in 50K of my own money, and then you guys are going to put in 210. It closes in a couple of days. He gets a carry if it's successful, and AngelList also gets a carry, but only if it's successful. So that's just a quick review of how these things work. And again, you're benefiting from Elad's research that he's done into the company. He's putting his own money into the company, and the fact that that's quite ominous. And the fact that he's got the relationship to even get the allocation in the first place. Everyone's doing this. There are over 8,000 people on AngelList that have backed a syndicate, and 56 million bucks for the next deal that comes on AngelList. And we did 104 million through this last year. Now, here are some tips. Here are some things to look out for if you're trusting a manager online. Firstly, make sure they have some skin in the game. Now, a lot of the platforms don't enforce like a strict limit here because different amounts of money are meaningful to different people. Some angels bringing deals to the platform, you know, $5,000 is meaningful. For others, that's a nice dinner. So I'd suggest something like 5%, that they're putting at least 5% of their own money into the deal. Secondly, make sure they're charging a reasonable carry. You've got to remember, you're paying deal by deal carry here, which is good if you want to dip your toe in, but if you're investing across a portfolio, say you invest in 10 deals by the same manager, if 9 of the deals don't make any money, you're still paying the full carry on the 10th deal. So make sure they're not charging carry like 30% or so, because when you run the numbers and you simulate that out, that's effectively almost 40% net carry equivalent. Thirdly, make sure they've got relevant experience and can actually help the company. I mean, if they've got a $250K allocation, that's probably a quarter of the seed round. The company needs help from its investors, and so that person offering up a quarter of the round really should be able to help them. Fourthly, make sure they know what they're getting into. You know, if you're investing, or if they're investing and bring an allocation in a database company or a developer tools company, make sure they have the experience and the knowledge to actually understand that, because you're really relying on their research. And then finally, make sure they have a decent track record and some deal experience. At the end of the day, they're the ones negotiating the docs with the companies. And you can see all of those docs and review them for yourself. But you need to know that they are not going to be caught and be blindsided by some sort of odd term that they haven't seen before, by lack of experience or otherwise. So they're my tips for backing people well and trusting a manager on any of these platforms. Finally, you could just buy the index. It's pretty daunting. There are thousands and tens of thousands of seed and Series A deals done every single year. And picking the winners can be very hard, and I've warned against that. So a lot of these platforms offer index-style funds, not a strict index, of course. So for AngelList, we have a fund that will get you into 100 deals per year for a 25 or 50K minimum investment. These are no-fee fund of funds. So they are funds that are set up that invest in all of the syndicates and pay fees, success fees on all those syndicates, but not at the fund of funds level. So no extra cost to buy the index. And it's pretty interesting, because this would never have been possible before. This is a semi-algorithmically executed fund that is able to do what it does because all of these deals are online in the first place. Some of the other funds, other platforms like Funders Club here, even offer thematic funds if you want to invest behind a certain theme and trust their investment committees. So as you can see, once you move all of these deals online, you can do some really, really interesting things. And I'll let your imagination run wild rather than trying to predict the future. But you can think of what could happen in the future. When all of these deals are online, when all your deal docs are online, when the platform knows exactly how much you've got in each company, it knows that your velocity or your rate of investing. It knows when to offer up a secondary opportunity, or when to ask you if you want to offer up stock for secondary sales. There's all sorts of really interesting stuff that can be done when it's online. So hopefully today I've given you a bit of an idea of how you can go direct, how you can invest and get exposure to private technology companies in a reasonable cost model. And to get started, all you have to do is go here. Thank you.